We were running these trades privately, this OTC ARB, it's delta neutral, asymmetric return, and we realized the last 2 years we were delivering pretty decent yields, real trading yields. And like together, that yield is just higher than anything else you could get that we've seen, even when you run liquid basis. An example is last year on, for instance, AVAX. If you ran AVAX liquid basis, it was around 28%. That's just buying the spot and shorting the perp at the same price in the market. But when you ran the delta neutral lock trades for 6 months on the OTC side, it delivered 114%, taking into account the discount, the perpetual, as well as the staking yield.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show spotlights Neutrl, the protocol behind a new synthetic dollar offering scalable institutional-grade yields by leveraging OTC discounts and delta neutral hedging. So that was a mouthful. Nomadic, maybe you can give us more of your impressions of Neutrl and this new yield-bearing stablecoin they've built.
Yeah, I think what really struck me with Neutrl was it's a case of I came in with some preconceived notions of what it was and almost like prejudged it without really honestly doing my own due diligence and looking into it, as you always should with this stuff. I think the OTC element scared me, but I think when you listen to Behrin explain it, it's a big part of the protocol, but it's still not all of their strategy. So I think that was a big takeaway for me, just knowing there's a lot more to it than just the OTC side.
In the podcast, we talk through step by step more about what happens, behind the scenes once your stable coins are deposited. And Neutrl is a part of this greater trend in DeFi to automate really advanced strategies. So make no mistake, anyone that's depositing into NUSD or holding stake NUSD, you are essentially giving up your stable coins to be managed by a hedge fund strategy. What they're doing here, though, is providing access to a sophisticated sort of trading strategy combined with this exclusive OTC access. So they have to source being able to buy certain tokens at a discount, top 100, top 50 blue chip type tokens, and then run this strategy, which is offering a much more compelling yield, combined with 90% of the pool, I believe, being in typical types of stablecoin yield strategies.
Yeah, there's definitely elements of Ethena here, and they're doing the Ethena style trade with the liquid portion of their book. And then they're adding on this OTC side, which is, as Behrin calls it, he's like, that's the kicker, because they can achieve very high yields on that. Even with only 10% of the book running the OTC side, it has a meaningful impact on the yield that's generated back to stakers. So I think people will be pretty familiar with a lot of this, but we dive into everything and I think dissect pretty much everything that's happening under the hood here.
And we're recording this in advance of them enabling public deposits. So for the last 3 to 6 months or so, they have been running this in a private beta, and they have around 50 million TVL, and they are earning an estimated 29.9% APY. So the goal here is to understand what happens once they enable public deposits. What do we need to consider as potential stablecoin depositors? What sorts of yields might they achieve? And can this scale as more folks deposit more money into the protocol? So on that note, just a quick reminder, you can subscribe at the-edge.xyz. That's the best place to get real-time notifications for any time we release a new podcast, or you can follow any of the weekly posts we put out, like Yields of the Week. And then if you check out our link tree at edge_pod, that's the best place to subscribe to the Edge Podcast on Spotify, Apple Podcasts, or YouTube. Otherwise, huge shout out to all of our sponsors. Thank you to the sponsors who make this content possible, folks like REDSTONE and TOROS Finance. Otherwise, we hope you enjoy the episode. Grow wealth exponentially. With TOROS leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. REDSTONE is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, REDSTONE delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose REDSTONE oracles, such as Ethena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need REDSTONE's leading modular blockchain oracle layer. To learn more, go to redstone.finance, and thanks to REDSTONE for supporting us here at the Edge Podcast and Edge Newsletter. Banks use your money to line the pockets of shareholders. Meanwhile, Solstice uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. A live delta neutral strategy with positive returns month over month for 3 years. Built for internet capital markets and powered by the stablecoin USX. To learn more, go to solstice.finance. Falcon Finance, the team behind the fastest growing synthetic dollar, with institutional yields that are competitive and sustainable, offering yield optimized across your favorite DeFi protocols. Point season is now live. Learn more at falcon.finance. All right, let's introduce Behrin, founder of Neutrl Labs. Behrin, welcome to the Edge Podcast. How are you doing?
Very good. Thanks for having me, guys. Been a long time viewer.
In order to appreciate what you're building with Neutrl, we're really going to take the time today to give the background on how OTC market strategies work, the need for delta neutral hedging strategies, and how you've kind of brought all these strategies together to ultimately offer us a killer yield and a yield-bearing asset. Why don't we start with more about your background, and then we'll get right into Neutrl.
So I actually started off in TradFi. I was in equities at JP Morgan for a long time, covering financials. And then I moved into VC, about a $20 billion book where we own most of the banks, asset managers, insurers. And then we did a few newer type of investments into crypto exchanges around 2015, 2016. Back then, there was largely just remittances and Bitcoin and Ethereum. And largely exited those to DCG, and then went to business school around 2020 after COVID. And I think I had an existentialistic crisis because it's something I thought I would never do at that point in my career. And got very intertwined into the early DeFi protocol boom and DeFi summer, being in London, and a lot of great DeFi protocols at the time, and working around Oxford, Cambridge, and London together. And I just thought I'm not going to go back. And since then, it's just largely been deep into DeFi, yield farming, as well as trading.
So can you talk to us about some of the challenges that newly created or even long-time tokens face? Where's the opportunity for OTC market strategies? What exactly does that mean? And who are you catering to on the backside of running this strategy?
Yeah, so this actual OTC arbitrage strategy isn't a new trade. It's similar to like just doing a liquid cash and carry that Ethena would run around USD. Basically, it's been done for the last 4 years at big scale privately by the larger funds and market makers. So the reality is, I think we all can agree since 2021, there's been a lot of VC capital into the space. And from that, it's creating a lot of excessive market caps and fully diluted values around many tokens. And things have changed since 4 years or 5 years ago when there was just maybe 20 tokens which you'd want to invest in. Now there's hundreds and hundreds of projects that have been backed. and are sitting at valuations that are in the billions of dollars. Some with actual very little use case, I would say. So largely what has happened is I don't think capital has actually increased that much in the system. So it's largely capital that's flown around, and there's no actual bid that's coming for a lot of these tokens. So what happens with OTC is early investors, funds, VCs, even foundations that are actually running their products now and they keep building, they go to private markets to look for liquidity for token sales. And they often sell these tokens from the foundations or their early investments, which have marked up quite substantially since when they got in at a deep discount. So it's like either between 20 to 70% type of discounts you see.
Behrin, I want to get even more into this OTC side of the equation. But first, can you just give us the high-level overview of what Neutrl is and what your goal is with it?
Yeah, so I think Neutrl, if you actually take a step back before it became a product, we were running these trades privately, this OTC ARB, it's delta neutral, asymmetric return, and realized the last 2 years we were delivering pretty decent yields, real trading yields, not yields that are out of token emissions, etc., just actual yield from buying the trade. So what we would do is we buy tokens at a discount, anywhere between 20 and 70%, and then we short perpetuals. And then we short perpetual across multiple venues, Binance, Bybit, OKX, etc. And what that creates is various forms of revenue on the trade. So the first form is, of course, this discount unwinds as you release the perpetual and spot over time. The second one is because you're short the perpetual, you actually earn funding on that, similar to how USD works. And the third one is the underlying collateral. Even though it's bought at a discount and it's locked for some duration, you can actually stake it. So you're earning on that as well. And like together, that yield is just something higher that you could get, higher than anything else you could get that we've seen, even when you run liquid basis. An example is last year on, for instance, AVAX. If you ran AVAX liquid basis, it was around 28%. That's just buying the spot and shorting the perp at the same price in the market. But when you ran the delta neutral lock trade for 6 months on the OTC side, it delivered 114%, taking into account the discount, the perpetual, as well as the staking yield.
So one other thing we were talking about offline was just this opportunity that's emerging with all of these altcoins that are coming up with unlocks and the massive overhang of supply. And there's this question of who's going to buy this stuff. So can you speak to sort of the opportunity that this brings to light for you guys that are actually very happy buyers of some of this?
Yeah, of course. I think, firstly, I always like to say that this isn't a trade that we have done or created ourselves. It is running. It's run by a lot of the best market makers and funds out there. I think what we're doing is bringing it on-chain and allowing access to it. So others that wouldn't get access to it unless you're a massive fund or a very big angel, to be honest. So largely what we're seeing right now, and this is all on-chain data, in the next 2 years, it's going to be over $55 billion worth of unlocked tokens. And this is coming from the last vintage. And these are all going to be front-run between the next 6 to 18 months. And these are in the top 100 tokens. So it's not even going too far out. And these are tokens that I think it's difficult to, we've all been in the crypto space for a while, difficult to actually support this bid on the unlock. And what usually happens around unlocks is foundations and teams or even early investors know that tokens were unlocked, so they do come to private markets and they look for an exit at some sort of amount of discount.
In terms of sourcing those deals to buy discounted tokens, talk to us about that. Where does that come from? Who is the ideal individual or entity that is approaching you as Neutrl?
Yeah, so I think OTC also gets a bad rep in the space, as it should for certain reasons, because there's a lot of shady things that happen in Telegram groups or private chats and Twitter DMs. But realistically, we only deal with institutional brokers, foundations directly. and big VCs themselves that are reputable and actually have this. And then the ideal candidate is largely working with someone like Styx. They're one of our investors. They are doing over $100 to $200 million of like deal flow a month right now from like the top 25 to 30 actual altcoin and foundations directly. And this makes sure that like legally you have access to the token, but also, to be honest, like legal to me is just a piece of paper. Largely what happens is when you deal with the right players and the right teams, you are transferred those tokens as well. So it's sitting in like vesting contracts on chain, and you actually have control of it also.
One thing when I first heard of this, being a bit in the VC investing game myself, I was like, oh man, are they buying 1-year locked tokens with 3-year vests? We've spoken a bit about this together, but I think it's worth outlining this for the people listening. What are like the term length and durations of these deals that we're talking here?
Yeah, so I think when you actually do business in the right way and you build a reputation and you're not trying to take advantage of teams, you get repeat business. So largely the term and deals that we've done right now, we're running 50 million privately. The average duration is around 3 to 4 months. So largely these deals are coming in. We bought tokens around 40 to like 45% on various tranches and right now, and they roll over in about 3 months and it's cash into neutral.
Behrin, I wondered if you could just walk us through an example. So maybe how a deal comes to you, how your team decides, hey, this looks good, and then next steps, kind of the process of bringing it into the fold and putting it on as a strategy.
Yeah, sure. So it's actually a lot of work that happens behind the scenes. So largely we are either approached by a foundation or an investor that wants to sell some of their tokens at a discount, or we put together an actual strategy for a team and we approach them. What we would do is if we are approached this token, we actually analyze how they would actually operate, how would the hedge actually work if we were going to actually hedge a significant amount of tokens, what's Styx liquidity, what's the perp liquidity across multiple venues, the open interest, the daily volume that's actually seen on the token, and then what we can actually expect from funding, because I think that's quite important as well when open interest changes. So we always model like very negative funding into the deals. So it's captured in the discount that we are given to give us a bit of margin there. So once all of that is done and we are happy with the terms, we then will actually pay for these tokens. So we pay either through an escrow or we pay through another institution that's reputable, and the foundation receives that. And then before that, we'll make sure that we actually have the token sent to us, investing contracts, and they're actually on-chain and verifiable and can't be, and nothing can be changed, right? So it's all sitting within the protocol. And what happens after that is basically the trade is put on. So once we know the legals are done, we have control of it. We have these tokens in custody. They're sitting on these vesting contracts. Then we use institutional custodians and off-exchange settlement like Copper Clear Loop and Sifu to run the hedges on multiple different exchanges. We wouldn't just use one venue. And at that point, the trade is on, and how the trade will come into become actual cash is over time, as these tokens start vesting, we start rolling off a portion of the actual spot. So we start selling the spot OTC token that we bought, and then we start rolling off the perpetual. And this difference in discount, the funding cost that we paid and the staking starts getting paid out to holders.
This episode is brought to you by MANTLE, pioneering a revolutionary new category called blockchain for banking by bridging TradFi and Web3 into one unified stack. With on-chain transactions, TradFi rail compatibility, and integrated DeFi features, MANTLE is reshaping how financial services work. Their flagship app UR lets users hold fiat and crypto all in one Swiss-backed account, making real-world finance usable on-chain. To learn more, go to ur.app and follow Mantle_official on Twitter. Maple Finance is one of my favorite products in DeFi. It is a gateway to sustainable real yield powered by over $1 billion in AUM across USDC and BTC products. And now with SYRUPUSDC by Maple, anyone can earn institutional grade yield. Learn more at syrup.fi, and thanks to Maple for supporting us here at the Edge Podcast and Edge Newsletter. Before we talk about the actual yield strategies, can you talk to us about, will this work in any sort of market, bull, bear, sort of flat, consolidating, ranging market? This is something that we've all talked quite a bit about in regards to something like the Ethena trade. So what are your thoughts there?
Yeah, I think like most trading strategies in crypto are market dependent. Even if you're doing like stat-arb, MEV, or even a cash and carry basis, like Ethena, when leverage comes into the system. With us, what we've seen is there's different ways that we generate revenue. The main thing is the actual discount. So like even volatile markets, or if it's a bit bearish or a bit bullish, we've locked in that discount. So that the difference between the two prices get paid up. In a bullish market, we actually earn more because funding rates actually increase. And that's why you see these liquid like cash and carry or Ethena as well as really well in the bull market. In a bear market, the trade is even better because teams are willing to sell even more, as well as there's less risk on actual like the hedge going up. So you just have less margin to use, and you're able to actually run the trade even safer. So, and then in a bear market, when you actually expect most of these other liquid yields probably come down pretty low, I think we're still pretty good in double digits.
Behrin, something you mentioned in there, when you're unwinding a position, I was sort of wondering if this careful unwind of position actually helps the industry a bit with essentially an orderly selling, because of course you're trying to get the best price, so you're not market dumping massive clips, I'm assuming. So can you speak to how this overall system is actually beneficial for not only yourselves, but say like the foundation that you're buying the tokens from?
Yeah, I think many people think foundations or teams sell OTC just to buy something, or buy a yacht or Ferrari or whatever. But realistically, really good teams in the space have a lot of developers, a lot of like employees to pay. They keep building. If you look at the blue chips that have been around for the last like 4 or 5 years, especially on the DeFi side, they are still innovating. I mean, Pendle's come out with Boros now, DeFi'S doing the cash card. These are things that people like cost money to actually run. The unfortunate thing is that, in the past, I mean, not in the past, it happens right now also, but you go straight to an investor or market maker, you sell them OTC, and they often have no incentive to actually manage the way they execute that trade. So the way they put on a perpetual, you can actually see people in the order books. Like for us, who've done this for a long time, we actually can kind of figure out who's trading it or what's happening right now. So the end game for us is to actually have repeat business, to actually be very transparent, even with not just our users, but like with the guys that we're buying the locked tokens from. So they know that they can come to us and they trust us. And you're right, like it is about generating the best return as well for our users. So we are going to go in there and just slam an order in. It needs to be done quite well. And the rest of the team, besides me, I mean, they all come from market makers, institutional funds who have been doing this for like the last 6-7 years. So they know how to do it professionally, I'd say.
I want to talk a bit more about the full composition of Neutrl, because I think the OTC side has got a lot of buzz and most people have paid attention to that. But speak to the other strategies that you're running under the hood. And then also, what percentage does the OTC strat make up within all the strategies of Neutrl?
Yeah, I think there's a layered approach to that question. And I fully agree with you. Most people just think Neutrl is an OTC arb, synthetic dollar. But realistically, that would be quite dangerous to run. I'm not saying on individual trades, like even the way we look at the portfolio, the entire synthetic is made out of liquid and the OTC arb. The OTC arb is only about 10% of the entire book right now. The other 90% is liquid strategies. And this is liquid strategies doing normal cash and carry and basis on anything that works. and is doing well in the environment. So it's not just stuck to Ethereum or Bitcoin, different levels. So we can move it around. The actual OTC portion is very interesting because even though it's 10% right now, it's delivering around 60% APR. So although the overall book is doing closer to about 29%, the OTC part is the kicker. But I think we are very strict because people may also be like, why don't you just deploy more with a higher type of return or yield? I mean, at the end of the day, we're not a prop fund. We're trying to build like a synthetic dollar that can be used across DeFi and be composable. So it needs to be portfolio managed. So you can hold margin across the different venues and still run a liquid basis on it. So you're earning on it, as well as have like yield-bearing stable coins backing it. So like the entire book should work and be quite capital efficient.
For anyone that is looking then at this NUSD, a synthetic dollar versus the staked yield-bearing version, what you're talking about is really important to consider because a lot of the other yield-bearing stablecoins out there are just backed by stablecoins that are earning some yield. So the risk, but also the opportunity here is in what you've talked about, I believe, with buying these tokens OTC and running strategies. Do you foresee increasing that percentage allocation beyond 10%? I mean, I am imagining you're going to have some pushback from folks looking at the opportunity again and the risk here, because the risk is that you guys screw up and some strategy here doesn't go as planned. The token that looked like a top 100 blue chip token is falling in price, and maybe something in your hedging strategy isn't working as planned. So I think what I'm trying to do is just call out where can things potentially go wrong here, and what sort of process or protocol do you have in place to prevent things from going wrong?
Yeah, I think that's a very good question. So in us is a reason why we've kept the liquid portion such a high percentage. But realistically, you had one example there of a token like just blowing out. If that actually happens, it makes the entire trade a lot safer because the locked OTC portion goes down, but the actual short starts printing into cash. So if you actually started running this trade last year, which we were, and you saw a lot of launches at the time and a lot of tokens that were sitting in like 2 to 3 billion FDVs, what we saw is we were buying tokens at like 40-50% discounts to what they were on the market price. And if you run the playbook to this year, all these tokens now are down 80 to 90%. And what that actually means is the hedge just started actually being more profitable. So you actually need less margin to protect it. The real risk here is largely on duration matching. So if we are doing OTC and we're not liquid enough to actually put up margin against it, but this is why in the protocol we will have a way for people to choose their duration of stake, similar to like how an insurance book would work. I used to cover insurance at JP Morgan, basically like an embedded value, where you basically would match what someone is locked in to the type of deals that you can do. The other part is completely liquid and can be used as margin in a case that one token does a 2x, to be honest. But even with that, like the OTC portion can't be, even if it's 10%, can't be 10% in one token. It needs to be across many different deals. And the chance of tokens all ripping 2x or 3x and now are very low versus a few years ago. If you run actual like simulations on tokens from the last 3-4 years, it's very rare that 2 or 3 tokens actually do it in the top 100. The time you get it would be like something like a Ohm or some other type of things will involve it.
So Behrin, knowing now that the current strategy is about 90% delta neutral, and you're also holding, I believe, some yield-bearing stable coins, can you identify like a few of the tokens that you're doing the delta neutral strategy on, and what sort of yield-bearing stable coins make or fit your criteria to hold, I guess, on your balance sheet as well?
Yeah, so the entire book is delta neutral, even the OTC ARB, largely. On the OTC ARB side, there's 5 deals that are live right now that have already started paying as well. They started vesting and they're paying out over the last couple of weeks. The liquid side, that has moved across multiple things. So we were running Bitcoin basis for a bit when it made sense, but largely we were looking at things like Ripple, Hype, Solana, AVAX, Sol, Sui. So everything else that was actually higher than Bitcoin and Ethereum basis also. The other interesting part is the yield-bearing stable coins that we use are USDE. And it's not largely because USDE is, I think, the best product that's come out of crypto in the last 2 years. But largely, if you run this trade, it's become so capital efficient because you can run USDE as collateral on Bybit, for instance, now, and it'll be Binance. You get paid USDE basis for the shard, and then you run your basis on top of that. So it's actually, you get a kicker to your own basis. So that's one of the stables, and we also have Sky in there. Because I think that on the redemption side, it's a lower yield, but it's still very liquid and very easy to get out of any of.
For running that hedged OTC strategy, previously you've mentioned to Nomadic and myself as we were, learning more about Neutrl, that you are, sticking to like top 50, top 100 tokens. There's a need for the token to have established liquidity. Am I missing anything in terms of the hedging strategy is you require a perps market and then you are shorting that. So you're buying, let's say it's, something like the Uni token. I'm just making this up on the fly. You buy the Uni token discounted. Let's pretend it's vesting over like 3 years. And then you're looking to short that on the perps market, assuming that you can collect the funding rate from that in most markets. Am I missing anything else there? I guess, is there any other possibility for you to basically hedge these OTC bets?
Yeah, so there is one, and we actually do it as well, but I don't think it's something that we have educated most about. So largely it is, you can also take out a loan from some investors or a loan from the foundation itself. That removes the entire perp hedge risk of something rallying. You would pay out a fixed amount, similar to how Pendle Boris is operating now, and I think they will grow and become like a great product. And once they have more actual open interest, it's something we would use a lot more as well. That makes sense because you're just swapping out the funding risk on that side.
River is building a chain abstraction stablecoin system that connects assets, liquidity, and yield across multiple chains. Season 3 is live. Earn River points by using sat-USD in DeFi such as Pendle, PancakeSwap, and Uniswap. Stake River points to accumulate more or convert points to River tokens whenever you like. To learn more, go to river.inc. Hey folks, I want to tell you about our sponsor GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions. With battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs, Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi.
So we've talked a lot about how all these strategies work for Neutrl, but we haven't touched on quite enough probably how this yield gets reverted back to end users. So this is probably a good time to break down NUSD and sNUSD.
I can unpack it a bit further. I mean, how it actually, like the user flow would work very quickly. So somebody would come into the protocol, they would mint NUSD, largely using USDC, USDT, or USDE. On the back end, the protocol then will send them NUSD, but their funds are taken to actual institutional custodians like Fireblocks, Copper, Clearloop, and Sifu. And then from there, the trades are actually open. But the difference between the two tokens is NUSD is just the token that will always be close to 1 because it's backed by completely liquid instruments and cash and carry basis, similar to Ethena, like on a synthetic dollar side. And how the difference is to generate yield or to be paid yield, a person would stake NUSD, and then their staking would depend on different durations that they choose. And that's important for us because we need to know the actual book duration before we actually go and do an OTC deal. Otherwise, we'd just be completely liquid.
Okay, you talked about something there that I was confused a bit about, and it's this idea of duration, because I was thinking through this. If I'm an sNUSD staker, you're doing these sort of long, maybe it's a 2, 3 month, 4 month strategy. So how do I kind of match with a certain deal? Or can you speak a bit to more of the duration? Like, what do people have to come and do? Do they have to lock for a certain amount of time as a staker? Or how does that duration element work with your strategy?
Yeah, so we'll reset the yield at different various points. So it'll almost be like a flywheel. There will be deals that have already been live. The yield will probably look quite high, to be honest, versus what's out there. And I think that makes it quite attractive then. So people will come in and lock for a certain amount of time. Once we see that book, it almost, the analogy I think of is like an insurance book. Like the actual book keeps rolling, and then you can see how like the cash flows would work. Once we know that, then we can enter new deals. But of course, if someone comes in there and stakes, the yield that will be paid out will decrease, and then they probably unstake, and then we'd have to roll it again, and the yield will go up. But it's the only safe way, I think, for us to match the trades.
So we've got NUSD, and NUSD is the non-yield bearing form. I'm assuming there will be like opportunity to provide liquidity for it so folks can easily get in and out of sNUSD. sNUSD, is that the only form of the token, or is there sNUSD versus a locked form of sNUSD? I guess if you're holding sNUSD, are you locked for a certain time frame no matter what? It's not something you can just instantly withdraw from.
Well, on secondary markets, you may be able to, because there'll be DeFi composable across Pendle and Morpho and Euler, and Curve will be there for NUSD. But for the actual protocol, there'll be a redemption time that you would have to work out. I think we'll start a bit longer initially at around 30 days and then drop it down over time as we scale. But as you're sitting within it, you will be able to earn the yield and still actually use it across DeFi.
We've covered Infinify on prior podcasts, and full disclosure, both of us are invested in it. And it feels like there's a real synergy between what you guys are doing and what they're doing.
Honestly, they're great. They're great because they create like almost a secondary soft lock for Neutrl, right? So similar to Pendle, forget about coming to the protocol and locking and choosing your duration. But if you are on Pendle, if someone's in the Pendle side, that's a soft lock for us also. And then someone like Infinify, if they're going to keep rolling it because they've got an institution that they're generating yield for, it's a great partner to have. And those are the type of partners you'd want believing in you, and like you're actually getting paid. You pay them the yield and they keep rolling it because they realize the best delta neutral yield they'll get. But it's just a great partner. So that's why I said it. And we've chatted before, and it was their idea as well. And I was like, actually, it's quite impressive what they've done on sourcing capital in the last, I think, 3-4 months.
The way that DeFi has matured, I think specifically in the last 1 to 2 years, is there were simpler options, and all of us were just using the same options. You had something like Aave, and you could lend or you could borrow, but there wasn't a lot of choice. And then you look at what Morpho did in creating these very curated markets, and at first that looks really interesting and accessible for anyone, but in truth, it creates almost something like a new on-chain middleman. Call them, the curators, or someone who's running an automated vault. Or in the case of Pendle, Nomadic and I love to navigate all the different Pendle opportunities, but having to manage those expirations, those maturity dates, and then think about rolling that over to another
getting
pool.
in also, right?
Getting in, yeah. So there's an opportunity there to automate that, and that was what was so appeasing, that was what was so interesting to us about Infinify, and so we're recognizing a parallel here with Neutrl, where by locking folks up for, in your example, like maybe 30 days, it allows you to run better strategies and ultimately offer better yield. If folks want to instantly withdraw from a yield, there's tons of opportunities out there still, and there will always be the Aave lending type yields. But yeah, I love the direction that our space is headed. I think it mirrors the kinds of competition that you see in the market, the better yields, and the opportunity for all these different players to add value by, curating and automating these different types of yields.
I think you're 100% right. I think we're going to a bit more of an institutional mindset finally, since like early DeFi. So there are actually a lot of players that are coming in now. I know we've all been waiting and wishing for about 5 years that TradFi is coming, but they are. And these family offices, etc., they do understand longer duration. They don't need to be liquid in a day or 2 days if the yield actually or the trade makes sense. Yeah, so it's just really good for capital coming into the ecosystem.
Yeah, I totally agree. And it's rewarding delayed gratification rather than, just instant dopamine hits. It's kind of win-win as well. So yeah, definitely a trend I like to see. One other thing I want to talk to you about, though, is something I'm always curious about with these new teams, especially in the yield-bearing stablecoin space. So you've got to find a way to reward the sNUSD stakers, of course, with the yield. But I'm assuming there's going to be a neutral token, and I'm wondering how you start to direct the yield flows or the revenue flows of the protocol to the staker side versus the governance token side, assuming that, I'm making a lot of assumptions that there will be a fee switch at some point. But just curious how you are thinking about this at this point in time.
Yeah, I think it's a very good question. And often the way we think about, we thought about Neutrl before even deciding to launch it, was what's the end game, and largely where you'd see the most value. But saying that, I think realistically, we're going to be public in the next few weeks, and we need to make sure the synthetic dollar is secure, is safe. So yield will be paid out to stakers, largely users, people that actually use the protocol and NUSD, cross DeFi, provide liquidity to it, as well as building up an insurance reserve or insurance fund. Because I think that is super important. Because yes, we can run Neutrl as it is and just as a portfolio, but if we can actually build some safety net around it, that's quite important. Over time, many years down the line, maybe not in many years down the line in crypto terms, that's 6 months down the line, but there's a way that, Neutrl holders would also be able to earn from the yield. But I think it has to be more priority on users backing, Otherwise, there's no point to have a Neutrl token if NUSD doesn't do well.
So we've talked through many of the current Neutrl strategies. I'm wondering if there's any other sources of yield you're looking into right now for Neutrl. I don't know, maybe it's private credit, maybe it's something else, or any key integrations that you're excited about.
Yeah, I think we are just trying to make sure we execute the current strategies quite well. Because right now, even this OTC ARB is a bit more exotic than most people have had access to. It's something that is institutionally done, all the time, but it's never been available for retail or just in DeFi in general. So we're focusing on that, and we're keeping it to liquid delta neutral and just yield-bearing stablecoins for now, because I think that's the best way to run the portfolio. Over time, there's been a lot of interest from other parties to actually add other strategies for Neutrl get involved, but I think we just need to make sure this works quite well.
As I'm sitting here thinking of all this, I'm also thinking about how scalable this all is. So I know you've got 50 million deployed in the beta. You said about 10% of that is maybe for this OTC ARB strategy. So call it 5 million. Can this get to $1 billion? Can this get to 2 billion, 3 billion, 4 billion, 5 billion and still be scalable and still be generating the level of yield that you're seeing right now with this? I think it's more than a proof of concept. You've got 50 million in the beta, but yeah, what are your thoughts on scalability?
Yeah, I think we're approaching it in different ways. So like right now, if we assume that Neutral's portfolio only stays at 10 to about 15% in OTC ARB, we have about $350 million in actual blue chip OTC tokens we could buy at decent discounts. We have not deployed just to be actually risk managed on that. And considering like the most of the actual portfolio backing the synthetic is liquid, I see this easily in the billions of dollars, in the sense that, yes, the yield may come down. So I think probably we hit a lower threshold of yield over $500 million. But before that, it will be real trading yield around the 30% mark. But saying that, we'll still be in a pretty decent place, higher than most on-chain yields, even at scale.
Guys, I think this is a great place for us to wrap up. So I want to remind our listeners they can learn more about Neutrl by going to neutral.fi. They should follow Neutrl_labs on X. Follow Behrin_N on X. We'll put both those handles into the show notes so you can easily find them. And then Behrin, thank you so much for coming on. We're really excited for you to get out of this private beta phase. I guess first off, when will public deposits open? Like when will anyone be able to access Neutrl, and any other final word for us?
Yeah, so it feels like we haven't been sleeping for about 6 months, but largely right now, we're very close to public access. We've made sure everything is secure on the custodian side and smart contract side, and all the different centers of integrations already across DeFi. So it will be open the next few weeks. I just want to say I appreciate being on the show, and I think you guys are doing great. Thanks for the space around education, and looking forward to Neutral's launch, and hopefully you guys using Neutrl in the future to earn some really good yield.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.